Well, hello and a very warm welcome to this webinar on the European Banking Outlook 2024, brought to you by Scope Group. My name's Keith Mullin, and it's my pleasure to be your moderator for today's session. Our task today is to give you some perspectives on the shape of the European banking sector and how we believe key metrics around profitability, asset quality, and solvency will progress this year. We'll also address some broader sector issues. Now, of course, defining future outcomes against a backdrop today of geopolitical strife, political intrigue, economic uncertainty, and a less than clear monetary pathway is no easy task. But I'm delighted to be joined by Marco Troiano and Nicolas Hardy, respectively head and deputy head of Scope's FI team, who will attempt to do exactly that in a moment. Now, Marco will lead off with a short presentation laying out some top-line thoughts, and after that, we'll move to a Q&A. So please do type your questions in as we go along, and we'll be delighted to answer them. Before I hand it to Marco, I just wanted to draw your attention to the Banking Outlook research document that the team published early this month on January the 15th. This and today's slides will be available for download at the end of the session. So that's it from me. Marco, Nicolas, great to see you as always. Marco, let me hand the floor over to you.
Yeah, thank you, Keith. So the idea today is really to have a bit of an open conversation. I'll give this short introduction, going over some of the key themes that we've identified from our exercise that we do annually, looking at the perspectives for 2024. And then, I look forward to hear from the audience what are the key questions or even comments or topics that they would like to address with us. Before we start, maybe just a note on the portfolio we look at. So we have a coverage of 125 issuers in Europe, in financial institutions from over 70 different bank and non-banking groups. 90% of our ratings carry a stable outlook. So in other words, we see downside and upside risk broadly balanced in terms of the direction of our ratings for the next year. And this is reflecting an expectation of mild deterioration in fundamentals, but from a very, very solid point of view. So I will go over for the next, I would say 5 to 10 minutes, a few slides. The first topic that I would like to draw your attention to is the dynamic of net interest margins. So this has been probably the key driver of the increase in profitability over the last couple of years. We've seen net interest margins spike first in 2022 and then in 2023. We don't have the full year results yet, but that's our expectation for the time being. And that will change in 2024. We actually expect net interest margins to start declining in 2024 and then in 2025. We know that policy rates have probably reached the peak. Our base case assumption is that the ECB will start cutting rates later this year. Our expectation is for 75 basis points in 2024. And for net interest margin, we see it going down from around 1.7% to 1.6% next year and 1.5% the year after. The charts you see on this slide show exactly the difference between the lending rates and deposit rates for key products for European banks. You can see that it's been going up very sharply following probably what's the fastest increase in rates since the euro introduction, really. And this has accompanied basically the repricing of assets and liabilities in the banking system, where assets have generally been repricing with a lag compared to liabilities. The second slide I want to show is actually showing on the right-hand side our expectation for profitability for the sector. So I've briefly discussed the outlook for net interest margin. I will complement that by saying that we don't see obvious factors counterbalancing the decline in net interest margins. This is essentially because we see volumes shrinking this year and non-interest revenues not being strong enough to compensate for the weakness. At the same time, we still see some increase in operating costs and some increase in cost of risk in the sector. So our expectation is that sector return on equity will peak in 2023 around the 12% mark, and then start declining around 10% in 2024 and around 9% in 2025. This is still a very good level compared to recent past. You can see on this chart, the historical average, say pre-COVID, was around 6 to 8%. So still good level of profitability, but declining compared to the recent past. Moving on to the next slide, which is about asset quality really, and justifying our expectation for higher cost of risk. This is another, I would say, inversion of a secular trend. We've seen asset quality improving for many years in a row, in fact, a decade, and we now expect a moderate increase in non-performing loans, which is something we've been pointing at for some months already, in fact, from the beginning of 2023. This is the result of the soft growth environment. Our expectation is for Euro area growth of 1.1%, which is good, I mean, positive, but below growth potential. And overall greater financial stress coming from the high level of interest rates, so higher servicing costs for existing debt stock. At the same time, we also highlight that banks enter this new asset quality cycle with very solid fundamentals. And we believe that the increase in NPLs will actually be quite gradual and very manageable from a P&L standpoint, which is one of the assumptions supporting our ratings positioning. The other key strength relates to capital positions. So European banks carry on average excess capital versus their requirements of an average of 400 basis points. You can see it on the right-hand side chart on this slide. And it's not unusual actually to see banks carrying over 500 basis points of capital in excess to the requirement. These levels of buffers are even higher than what management teams have generally been guiding towards. And for the past year and a half, large European banks have been returning excess capital to shareholders via dividends and buyback programs. But this level of excess capital is a protective feature for credit. It's an element which is supporting our ratings, and we actually expect it to remain in place in 2024. In other words, banks will be profitable. The profits that they will have will probably be distributed in large part, but we don't expect banks to run down their excess capital towards their management targets just yet. So I gave you a view of the P&L on the asset side of the capital. I think what's left is the liability side, which is probably what's closer to your heart on this call. The direction of travel here is very clear. Funding conditions will remain tight, not only for banks, but more generally. And yes, the ECB is more likely than not to cut rates, but at the same time, the central bank is also normalizing the balance sheet, which means that all of the liquidity that has been injected during the COVID period is now coming off. TLTRO3 repayments, you can see it on this slide. We have a big chunk in March. TLTRO program will basically end at the end of the year. And on top of that, the ECB will gradually reduce its participation to bond markets through lower reinvestment on its asset purchase programs. So this will translate in greater competition for private sector savings, and in the end, also for bank deposits and bank liabilities in general. I think this will drive a normalization of bank liquidity coverage ratios, which is something that has already started in 2023, and we expect it to continue. Once again, the banks are entering this new period from a very, very solid position. I will stop here with my presentation, and I will probably move to the Q&A.
Okay, good. Thanks very much, Marco, for laying out those thoughts. So let's go to Q&A, and please, if you have questions, type them into the questions tab on the platform here, and we'll pick them up as we go along. So Marco, just in a very short summary, your expectations for top line revenue, net interest margins, profits in 2024 will be lower than 23, but you're not particularly concerned about a outsized decrease. You think they'll just trend down and normalize.
Yeah, no, that's correct. So I must say this is not my expectations. This was a team effort. We've run a forecasting exercise with the team on the largest 40 banks in our rated sample. And I mentioned, I think our estimate for the margin is 1.7 for 2023, which is not an actual number, but our expectation for the year, and then trending down by about 10 basis points a year, which means you're still going to be slightly above the, say, 2020, 2021 levels. So for the overall revenue growth, we're looking at a decline of 1 to 2% in 2024 and 2025.
Okay, now bearing in mind your...
Sorry, my camera is flickering,
I think
so I'll just
we switch the camera off, Marco, and we'll hear you, I think, quite well. So bearing in mind the growth outlook that you the baseline that you laid out in your comments, but also bearing in mind not very strong credit demand, what are your expectations around volume growth? In other words, will a narrower net interest margin be compensated for by growth in volumes?
No, not really. We see a 1-2% volume growth in 2024 and 2025. This is essentially in line with GDP growth. The reason is that overall, Western Europe is a mature market. It's very difficult to see overall lending growth outpacing the broader economic trend. And then on top of that, you have some move from the regulated banking sector to the non-regulated NBFI sector, which is a result of the very heavy regulatory burden that has been imposed on banks. So some of the credit is actually migrating to friendlier balance sheets in terms of capital consumption. So overall, we don't see volume growth compensating for the narrower margins.
Yeah. Okay, that makes sense. Like, I wanted to pick up on some specific countries here, and in fact, there's a couple of questions that have come in from our viewers. And so, without going into too much individual detail, perhaps I could ask you both to outline some key takeaways from some specific European banking sectors, France, Italy, and Spain, for example. And before I ask Nicolas to kick us off on France, there is a question about when will French retail NII finally jump, Nicolas? Perhaps you can factor that into your answers. But there's also a question about what are the main reasons for the different NIMs in different countries. So with those perhaps in your minds, Nicolas, can you just lay out some top line thoughts about where you see the French banking sector?
Yeah, thanks, and good afternoon, everyone. So net interest margin, or NII, in France, it's a very interesting topic, because compared to the rest of Europe, most of the other European banking systems, it's really a flat line. It's not moving the way we see it on the chart on net interest margin in average in Europe. So it's a flat line. And the main reason for that is that balance sheet repricing is much less favorable in France than in other countries. So what do we have? We have a slow repricing on the asset side, mainly because most of the mortgage loans in France are fixed rates, long-term fixed rates. and liabilities are repricing much faster. So the net effect on French bank is not really positive compared to peers. So banks are guiding on the possibility that throughout 2024 this will normalize. I think where we are now, it's quite clear that it won't happen during the first half. Maybe second half we'll have this break even and improving net interest margin at the margins, I would say. So that's positive for the second part of the year, probably. The second element that characterizes the French bank, and it's very important in that context, is that the market is quite consolidated already. We have large French banks with well-rounded business models. So this element of diversification has been really a strength for the largest banks in France. So fee generating income, for some exposure to Italy, for instance, where NIM is much higher than in France. So some compensation effect thanks to diversification. So that's quite positive for the largest banks. So all in all, we have stable outlooks for French banks. We consider that this situation is hurting on profitability. I think we'll see that very soon when we look at full year results. That was obvious for some banks at the end of the third quarter. The trend will continue for some time, but the stable outlooks on French banks is really predicated on the fact that we expect this pressure on profitability to be temporary. And low interest rate on mortgages, for instance, also means that asset quality is very resilient. So they won't face cost of risk issues in this environment, which is something positive.
Yeah. Okay, thanks. And Marco, let me ask you, if I could, to speak a bit about Spain and Italy. But before that, there was a question: what are the main reasons for the different NIMs in different countries? I don't know if that's possible to answer in a few paragraphs, but you could pick that up and move on to Spain and Italy.
I mean, it's. I think Nicolas mentioned some of the elements. A lot of that is down to structure of the loan books, i.e., fixed versus variable. A lot of that is down to structure of the liabilities, i.e., price sensitivity of the deposit masses. So deposit betas, the term that the market uses these days, i.e., how fast deposits are repriced to the prevailing market rates. If you want to take a broader view, I would say it's also about the level of competition in the specific markets. So the more excess liquidity there is, the lower the pressure to reprice deposits on the liability side, and therefore the slower the increase in the cost of liabilities, and the more essentially the benefit that banks have had from the NIM. Then there is the business model angle, of course, where some banks by nature have a broader captive customer base on the deposit side, meaning they will structurally tend to benefit more than, for example, smaller banks or also non-bank financial institutions that capture funding mostly on the wholesale market, which is by nature more price sensitive.
Okay, and then can you talk about Spain and Italy?
Yeah, no, about Spain and Italy, I would say, I mean, the trends that we've outlined in the introduction also largely apply to Italian and Spanish banks. And maybe if I were to just highlight and single out some key differences. In the Spanish markets, we have coverage of the domestic banks, but we also cover BBVA and Santander. And we see a broadening gap in performance between the domestic and international players. And the reason for that is that, of course, these more negative fundamentals that we see in the euro area and in Spain will be more diluted by the performance of the emerging markets franchises of Santander and BBVA, which still have some residual growth on top of GDP growth from higher penetration and generally more favorable interest rate dynamics. With respect to Italy, I would actually highlight two themes. I mean, variation of the themes that we've already discussed. But on the asset quality side, I mean, this has been dogging Italian banks for the best part of the last decade. So we will keep a very close eye at the performance of the loan books in Italy. We know that it's really skewed towards SMEs, in some cases very small SMEs, which have been very volatile in terms of credit performance in the past. So essentially, going through this asset quality cycle will give us a very important data point to validate our thesis, which is actually that the origination standards have changed, that the asset quality debacle of the post-sovereign crisis should not be repeated anytime soon in peripheral Europe and including in Italy. And maybe the second point is, of course, on how sovereign risk perceptions will impact the sector. At the moment, it's very quiet, but with the ECB gradually exiting from its less, I would say, less standard policy measures, we'll have to look at how the market absorbs the stock of Italian debt, whether this has implications for the spread and therefore for the banks, both in terms of their direct exposure to this risk, but also in terms of their funding costs. So these are probably the two themes that I would highlight on Italian banks. Yeah.
Okay, good. Yeah, thanks. There is a question which is, do you have any concerns about specific countries? Now, the question actually pinpoints Germany, so I don't want necessarily to sort of hold you to that, but bearing in mind your sort of broadly, I guess, stable outlook, albeit slightly maybe downward sloping, any specific country concerns?
No, not really. I mean, I mentioned that 90% of our outlook are stable. We have a few positives and a few negative outlooks. They're broadly balanced. They are not driven by, I mean, there is no clear country bias. They're mostly driven by considerations about individual names. And with respect to Germany, I would say actually these, I mean, the last couple of years have given German banks a very important room to maneuver. I mean, they've been singled out in the past for their very high cost income ratios and overall low efficiency, and this has in turn, limited their capacity to invest. And what we've seen more recently is that with the improvement in efficiency ratios, they've gained a little bit of leeway to address some of their more structural issues. So I would say no particular concern. Commercial real estate is a concern generally in Northern Europe, but again, that seems very, very manageable. And we've seen recently the Signa insolvency hasn't really, I mean, it has brought, it will probably bring a wave of provisions at some of the Austrian and German banks, but nothing that cannot be managed out of ordinary profitability. So I would say no particular bank under the spotlight or banking system under the spotlight.
All right, understood. Thanks. Nicolas, I just wanted to put a question to you, if I could, about a very, very topical subject in the last year, which is about the stickiness of customer deposits. So how comfortable are you with deposit stickiness, customer deposit stickiness at banks?
Thanks. Yeah, interesting question. Yeah, that was a big topic a year ago with the US banks, the regional banks facing pressure on funding, indeed. And yeah, where are we now? I think after COVID, we have had an accumulation of customer deposit on banks' balance sheet, and with the rising interest rate, there is this possibility of reallocation of deposits by customers. But in Europe, I think most of the customer base, we are dealing here with retail customer deposits, which are sticky and granular. So it's really a strength for the banks. So what we observe is that the base of customer deposit is relatively stable. But when we look below the surface, it's also important to notice the shift from side deposits to time deposits, so remunerated deposit. And this is where for banks, maybe it's not really a funding issue for them, but more a profitability issue. Again, in banking systems where liabilities are repricing faster than loans on the asset side, then it put pressure on bottom line. So that's at the moment more an issue for banks. They are handling flows of customer deposit that are moving from demand to time, and it has an impact on P&L. But otherwise, it's less of a funding issue at the moment.
Yeah. Okay. Now, with that in mind, Marco, last year we had this pretty significant turmoil in the US, and it did take a lot of people by surprise. So now, with the benefit of hindsight, can you say comfortably that last spring's turmoil was an isolated episode and the causes have been fixed or dealt with?
Oh no, not really. I will never say that bank runs are an isolated case. There have been many isolated cases over the years. So I would say the situation has stabilized. But for me, last spring was just a very helpful reminder, as we call it, as we've noted down in the outlook, of the nature of the beast. Banks are highly leveraged institutions, and they will probably always be very vulnerable to sudden losses of confidence. And this can happen, very fast, especially in this, day and age of digital banking and digital news. So, no, I would say that's really related to the way banks work. Now, the causes, you can't treat them. It's almost an intractable problem. There are things you can do to limit the likelihood of bank runs or liability runs to happen. So, for example, Basel III, with the introduction of funding and liquidity prudential rules, is a very helpful step. Is it enough on its own? Probably not. The credibility of deposit insurance frameworks, very useful step. On its own, probably right now not enough because it doesn't cover a large enough part of bank liability. The availability of a lending of last resort, or a credible lending of last resort framework, is an element really limiting the risk. So I think the combination of all of these things is limiting the risk. It works very well in Europe. In the case of the US banks, you didn't have some of these elements in place. So you had, incomplete implementation of Basel III. You had problems with accessing lending of last resort. You had very limited deposit insurance on the banks that went under liquidity stress. So I would say Europe is in a better place compared to the US, but this is not something, no bank is totally immune from this risk. And there are things that could be done to make this risk even lower. So, the European Deposit Insurance Scheme, this is something that would further limit the risk of runs. The proposal from the Commission to further senioritize runnable liabilities, essentially. This is something that would help. There is now, some discussion around prepositioning of collateral with the central bank to make the lending of last resort framework more easier to operate. So all of these things could help. But I would say, short of going full reserve banking, you can't really get rid of the problem.
Yeah. Okay. Now, with reference to a specific question here, then, which is how does European banking system stability compare to US banking system stability, and where do you see the bigger risks? That's an impossible question, but could we infer from your comments that, broadly speaking, you're more comfortable perhaps with US banking system stability, given where we are today?
No, I think the last year was a wake-up call. So the one key, it's a very difficult question. Of course, the proof is in the pudding. But what we know is that for example, the degree of supervision and regulation in Europe is probably a notch up. The implementation of Basel III and the single supervisory mechanism, which directly looks at 130 banks. So every bank over 30 billion in assets is directly supervised by the ECB. And then a much broader range of institutions is supervised by the national authorities under the same umbrella of the SSM. In the US, until very recently, only the large institutions were subject to tighter regulations. I must say, on the other hand, in terms of financial stability, the track record of the FDIC in the US when it comes to bank resolution is extremely strong. The track record we have in Europe, we don't have a track record. Let's face it. We have had very limited cases of bank failure since resolution was established. And in the few cases where we had near misses, we always opted for other avenues or exception to the resolution directive. Okay, we had a Popular and then a few minor cases. So I would say on the regulation and supervisions, I must say I like the European approaches better. On resolution, probably the US approach is more credible on crisis management in general. But again, it's a very broad question.
No, it is. I think it's a conference on its own. But moving along, Nicolas, coming back to you, we still have some outstanding TLTRO, which got quite a big number. Do you have any particular comment to make about TLTROs and repayment?
So far, so good, I would say. In a nutshell, we have this chart where we highlight where we are and what remains to be repaid in the course of the year. So far, the execution of the repayments, it was really executed in an orderly manner, I would say. The ECB is still there behind and ready to help. That was the official message. So it's shrinking. I think that's the main difference compared to the quite a large number of years where we got used to hear about rollover of TLTRO facilities, and that time there is nothing to replace, and no one is discussing the possibility that it could be implemented. So at the same time, when we look at the funding structure of the banks, there is nothing replacing TLTRO in terms of a central bank facility at the moment, nothing massive. So banks are really on their own. And what is really comforting our views is that at the same time, we don't observe balance sheet contraction. So it really suggests that the still lending is relatively dynamic. And banks find they still have the possibility to finance themselves in the market. We've seen that during the recent weeks, very heavy issuances in the market, very active market. That's very positive. Banks are able to replace TLTRO facility, maintaining a decent liquidity coverage ratio, decent loan to deposit ratios, and there is no shrinkage of balance sheet. So all those indicators point to a sound banking system. So.
Yeah, absolutely. And look, I'm going to stay with you if I may, because I've got some questions here about ESG, which again is another critical, vital theme. As we have mandatory requirements coming in around CSDR, etc. Would you say European banks are in a good position to meet incoming mandatory ESG disclosure requirements?
So they are in good position in the sense that they are making efforts to align and comply with regulatory expectations. So I think that's the main challenge they face is the very rapid and large flow of a new regulatory requirement. So far, what we've had in terms of disclosure was more something on a voluntary basis, but relatively patchy. For us, as rating agency, we welcome the gradual standardization of disclosure. Still a long way to go. And banks are maybe, yes, in a good position because there is always some flexibility in the way regulators are implementing the new framework, for instance, to gather new data sets. There is an element of flexibility there. For instance, banks sometimes have the possibility to use their own methodologies to gather the data, explain how they come up with some ESG indicators. It will remain challenging to analyze because of the lack of standardization, but that's a work in progress. So,
okay.
Yeah.
Now, of course, disclosure is one thing. ESG risks in the business are altogether a different thing. And how do you feel about the extent to which banks have managed well their ESG business-related risks?
Yeah, so on that front, I think ESG, maybe we need to split, as always, the three dimensions. So governance has been there. It's a constant focus. Definition of risk appetite, how it's controlled, remains something vital for all banks. We haven't had big issues recently around governance issues. There are still some misconduct case litigation around that, but nothing big in last year, for instance. I don't recall any major governance issues. And regarding environmental and social risk, this is more a developing story for us, along with the implementation of the regulatory disclosure framework. So again, it's also a work in progress. What is maybe critical for banks in 2024 is the fact that ESG is often a source of polarization. We have many elections coming in Europe and elsewhere, and ESG is often a source of polarization. So for banks, it means reputation risk, and it means also exposure to policy risk. And this is also something very important to see the stability of the requirement for banks so that they can build the capabilities to extract the data we need to perform our analysis. So reputation risk, greenwashing, policy risk are also important on the agenda for 2024.
Yeah, absolutely. Now, fascinatingly, in the Outlook that was published earlier this month, there was this notion of this three tiers or three groups when it comes to ESG matters, and the Outlook focused on a group where sustainability is a low priority or no priority. There's a group where banks are working to address risks and vulnerabilities, and I guess the top group, which is where banks are not just managing risks, but they're looking to take advantage of opportunities that are emerging from this. Now, I guess we don't have time to go sort of bank by bank, but which group do most large European banks sit at this point?
Yeah, for sure, some are more proactive and active than others across Europe, and this is something also we want to capture in our rating construct on banks. So we have a dedicated step, long-term sustainability assessment, where we classify the banks. And indeed, most of the banks are sort of in the middle. We have this developing assessment, and some are advanced or even best in class. And this is a relative positioning, also what is critical. So we can always classify banks among themselves. What is important also is to observe that many are making efforts indeed to meet regulatory expectations, stakeholder expectations, broader pressure on them. They are moving all in the right direction, but really most of them are still developing capabilities. And the issue also for us is not about management of risks in terms of creditworthiness. It's also how some manage to articulate opportunities to grow and cement their franchise and strengthen their credit profile. So it's also this dual approach between risk and opportunities that we try to capture through that. And in some markets, some are catching up very rapidly. So the average is moving fast, and banks just need to follow on that. So that's why we do not expect a major change in the shape of the distribution over time. We will still have some banks that are more agile than others in this sector.
Yeah, absolutely. Marco, let me come back to you. There's a question, an interesting question, which has perhaps more of a macro thematic around it, and I'll just read it to you. Will there be a re-leveraging of the private sector in 2024 and 2025 after the high nominal GDP growth and low credit growth of the past 2 years? What does this mean for ratings?
Well, no, I mentioned that our expectation is actually not that we will see such releveraging. I mean, interest rates are coming down, but they will still remain high compared to historical standards. So overall, it will still affect demand for credit quite negatively, and you will have some growth, but really, I mean, our base case is a soft landing. So at least from what we can see in terms of lending surveys, the expectations are really not for an explosion in loan volume, something which I mentioned in an answer to a previous question.
Yeah.
So no, not really. In terms of what it means for ratings, again, it's an overall stability. So slightly declining profitability is the main impact. On the positive side, also slightly declining need for funding.
Yeah. Okay, staying with you, Marco. Look, I've got a question here about geopolitical risk. Now, look, it's interesting. Geopolitical risk is it's there. It's a reality of life. We can't get away from it, and it's not as if it starts and stops. But of course, the global picture looks particularly worrying at the moment, with so many moving parts. Now, how much of that represents a concern when it comes to how you assess the European banking sector as a whole? I mean, can you kind of factor in sort of more severe geopolitical risk factors into your outlook, and can you sort of dial that down up? I mean, it's a curious topic, but I wonder if you have any just thoughts about geopolitics and impacts.
Of course, it's something we cannot ignore. It's definitely on the map. But I would say for Western European banks, it's not a huge concern. I mean, the exposures. I mean, the major areas of conflict, right? Is the Russia-Ukraine front, the Middle East, and potentially the South China Sea. We don't have a huge exposure there when we look at our portfolio of banks. There was exposures to Russia back a couple of years back. They've mostly now been exited. So I would say it's not direct exposure. Of course, it's a broader concern that if you get supply chain disruptions in the Red Sea, then the growth outlook softens and inflation outlooks becomes hotter, and you have implication for monetary policy. It basically, the sort of supply side disruption tend to push for a more stagflationary environment, and that of course has implication for the way we look at banks, but I wouldn't say is an immediate concern. There is I think a broader topic of diversification and the value of diversification in a multipolar world. So the narrative of ever increasing globalization, which we've been living for the past 20-25 years, is probably coming to an end, has come to an end, and we're going into reverse. And you need to continuously question the diversification strategies of banks and whether things still make sense in this new world, and whether diversification in some parts of the world are worth more or less than in other parts, or whether they carry more risks than in other parts. So this is something that we need to look at, but I wouldn't say it's an immediate credit concern.
Okay, all right, very good, thank you. Talking of immediate credit concerns, Nicolas, Marco mentioned it very briefly earlier, but there's been an awful lot of chatter and stress around commercial real estate. We've seen some defaults around Europe. So the question really is, how insulated are European banks from any further fallout in this area?
So this is quite a pessimistic scenario. So at the moment, I think maybe exposure to real estate and commercial real estate is a differentiating factor among countries. So if we were to look at a list of indicators to differentiate, we've had this question at the very beginning. So we have the net interest margin trajectory. Maybe also we have exposure to real estate in general and commercial real estate. So it's hard to say that any bank or any banking system would be completely insulated, because when we look at how important it is, on average, it represents about 20% real estate activities, 20% of corporate loans across Europe, and in some countries it's up to close to 60%. So it's a material credit risk factor for us. At the same time, I think it has been under scrutiny for a while. That was a big topic during the COVID because of the change of habits, e-commerce, remote working, so already under the spotlight. It's constantly put on the list of regulatory priorities for quite a long time now. So banks are reporting on that. We've seen recently increasing transparency also during Q3 result on this specific topic. I think it's very important for when we look at this to differentiate within the exposure. So we have international, domestic commercial real estate. We have across sub-asset classes. So there is an element of diversification under commercial real estate. And at the moment, yes, in some countries we see asset quality deteriorating, but at the margin and at the moment it's still well under control. So it's an area to monitor, but the key issue we've seen recently, so either idiosyncratic problems for banks, a customer, large customer could face issues in this sector when there is a degree of concentration, but also maybe the main issue is about refinancing risk in the real estate market, more than really a credit quality issue at the moment. Of course, the two are related.
Yeah, that makes absolute sense. Thanks for that. Look, I'm conscious of our time and we do need to close in fairly short order. But so a couple of perhaps quick questions. Marco, could the banking sector face more windfall taxes?
Yes, for me, this is a sign of the times. We've pointed out before that we see banks as semi-utilities. They perform a public function, intermediation of money, and they benefit from support in difficult times. And when they grab the headlines for making a lot of money, I think politicians will look at that as a potential pool to draw resources from.
Yeah. Okay. Thanks very much indeed. Okay, here's I guess a perennial question which has come up in our feed here. Perhaps you could kick off, Nicolas, and Marco, maybe add if you have any additional comments. Are we going to see more banking consolidation in Europe?
Yeah, long-standing discussion on that topic. What is very clear and largely covered is how difficult it is for a bank in a country to replicate solutions, commercial proposition from one country to another. So we know that we've heard many complaints about the constraints that banks may face when they try to develop retail banking from one country to another using the same front-end solution or even back-end solutions. So the difficulty to have fungibility around that. And we know the same issue for liquidity management, funding management. So there are regulatory and commercial constraints. At the same time, we know that it's critical to increase size to gain efficiency. Plus, there are a few banks that are still due for privatization. So there is maybe this hope that European consolidation could emerge also from those opportunities that are still due for privatization. Or other partnership. I think we always focus on the possibility to see a bank merging with another one, and much less on the ability of some banks in some segments to develop the product. So the accounting, there is a location of the profit always, but some manage to develop solutions across countries, maybe not in the retail segment, but in other segments. It's much less visible, but this is how also the consolidation is gradually taking place.
Yeah. Okay. Anything to add, Marco?
No, I think Nicola covered quite well the topic.
Okay, very good. Well, in that case, I'm going to come to the last question, Marco, and it's to you, and it's an open-ended, potentially unanswerable question, but it's just more kind of getting your thoughts. And it's about digitalization. Now we live in a world of AI, central bank digital currencies, cryptocurrencies, app-based digital banking, disruption from potential non-banks, from big tech. It's a big topic, and I guess you know the themes. What are your thoughts here? Is this going to be a major game changer for European banking? Not this year. I'm talking really just more in an open-ended context.
I mean, it's going to be a game changer, probably not just for banking, but for many aspects of our lives. For banks, I mean, I would say it's another instance of a winner takes all. So it will increase the value of having, a very sizable data pool, of having a large investment budget to develop technologies. So it will, I think, play into the hands of the larger banks and raise existential question for the smaller, like local banks. So in fact, maybe going back to the previous question, it could turn into a driver for greater consolidation, or at least collaboration between smaller players. But for sure, it's it has a huge potential for cost saving. It has huge potential to improve the effectiveness of cross selling within banks. The question is, in the competitive dynamic, there will be winners and losers, and I think numerically there is going to be more losers than winners in terms of number of banks. And I've just seen, Keith, that there is another question on methodology that just came in.
There is, in fact, it's just coming under the wire. So let me ask it, Marco. Thanks for pointing it out. And is any impacts from depositor preference on your ratings methodology?
Yeah, I will. It is actually something that we already incorporate in our methodology. So our debt classes ratings are linked, of course, to the issuer rating, and then typically we equalize the rating of senior unsecured preferred debt with the issuer rating. When it comes to deposit ratings, they can be at the same level if there is no depositor preference, or they can end up, one notch higher than the issuer rating, and therefore the preferred senior bonds, where in countries where we have depositor preference. So it's something that is currently already in our methodology. Of course, if this gets extended to more countries, it will have, some implications for the way we look at deposits in these countries.
Yeah. Okay, good. Thank you very much. So I've got no more questions in the questions feed. So let me draw the session to an end. Before we go, if you wanted to download Marco's slide presentation and indeed all the banking outlook, you can go down to on the bottom of your screen. You'll see a button which says Apps. If you click on Apps and then click on Handouts, you should see two PDF download buttons there, and that's the Outlook and the slide deck, as I say. So while you're doing that, I'll very quickly thank everybody for dialing and listening and staying till the end. Thanks in particular to Marco and Nicolas for answering some pretty broad-based questions with interest and some really good insights. If you have any further questions, please feel free to reach out to any of us by email or whatever method you deem appropriate, and we're always here to help. Now, we will come back and look at this again later in the year, which may well result in another session perhaps after mid-year results, when we can also quiz Marco and Nicolas on whether their predictions have been right so far year to date. But for now, thank you very much. I wish you all a very pleasant rest of the day, and we'll be back in touch soon. Okay, goodbye from us.
Thank you very much.